As of right now, Plug Power Inc. is trading at $2.36 per share, seeing a dip of 3.63% or about 9 cents in intraday movement during this Friday session. On the surface, it looks like just another choppy day for a stock that has become a permanent resident of the high volatility corner of the market. But if you look at the timing, this movement is happening exactly 24 hours after the company had to hit the pause button on its high-stakes special meeting. Most people watching this ticker expected a clear yes or no on the massive share authorization proposal yesterday. But the reality is much messier. The company actually had to adjourn that meeting until February 5th because they simply didn't have enough votes in the room to push their plan through. It wasn't that people were voting against them in droves. In fact, the vast majority of those who did show up were in favor. It's that a huge portion of the shareholder base just didn't show up at all. This creates a fascinating tension because the market is now pricing in the uncertainty of a potential reverse stock split if this vote fails next week. The insight most people are missing right here is that Plug Power is essentially in a race against its own cap table. While everyone is talking about the 100-megawatt electrolyzer installation they just finished in Portugal for Galp, the real story is the voting math. They need 50% of all outstanding shares to say yes to doubling the authorized share count to 3 billion. Right now, they are sitting at about 37% and 47% for their key proposals. If they can't bridge that gap by next Thursday, the board has already signaled they will likely have to pull the trigger on a reverse split to keep the lights on and keep the listing active. This is the ultimate expectation versus reality moment. The expectation was that the hydrogen transition would be funded by massive government subsidies and clear-cut institutional backing. The reality is that Plug Power is having to beg its retail base to participate in a corporate governance vote just to maintain its financial flexibility. If you're looking at the landscape of online investing right now, you've probably seen the chatter on investing sites or your favorite individual brokerage app about whether this is a bottom or a trap. There's a common belief that the hydrogen sector is dead money because the infrastructure is taking too long to build. But if you challenge that and look at the actual physical deployments, the picture changes. Just last week, Plug finished that massive project in Portugal, and they've got facilities in Georgia and Tennessee pumping out 40 tons of liquid hydrogen per day. The disconnect between the physical reality of their pipes and tanks and the financial reality of their balance sheet is where the opportunity or the danger resides. This is why tools like Schwab Intelligent Portfolios or a standard self-investing strategy often struggle with names like this. The math looks terrible on a backward-looking basis, but the forward-looking capacity is objectively growing. The recent movement we are seeing today, that 3.63% slide, is likely a combination of fatigue and a bit of a wait-and-see approach from the big players. When you look at institutional activity, we've seen a lot of the heavy hitters like Fidelity and those managing big Fidelity ETFs or Fidelity mutual funds keeping a very close watch on the liquidity. If you're using the Fidelity trading platform or even the Fidelity mobile app to track this, you'll notice that the short interest remains high, sitting around 30%. That is a massive weight on the stock. Those shorts are betting that the company won't be able to secure the votes it needs or that the cash burn will outpace the revenue from these new European projects. However, for those who invest online through more retail-friendly platforms like the Robinhood app or via Robinhood fractional shares, the sentiment is often different. There's a segment of the market that sees this sub-$3 price point as a gift, assuming the company can finally scale. Let's talk about the trading volume and what it's telling us today. We are seeing elevated activity, but it's not the panic selling we've seen in the past. It feels more like institutional repositioning. If you're checking your Robinhood investments or your SoFi active investing account, you might see that the bid-ask spread is tightening. This usually happens when the market is trying to find a floor. People are trying to decide if the 24% gain we saw over the last month was a true trend change or just a dead cat bounce ahead of this meeting. The reality of the situation is that Plug Power has a massive funnel of potential work, over $21 billion in the European pipeline alone, but they are currently strangled by the cost of capital. For those of you holding a position, I want to hear your perspective. Comment below how many shares of Plug Power you currently hold and what your average cost basis is. It's always helpful to see where the community is standing on these high-conviction plays. While you're thinking about that, let's look at the broader sector momentum. We've seen other names like Fuel Cell Energy or Ballard Power move in sympathy with Plug, but Plug is clearly the leader of the pack. If you're using Interactive Brokers or the Interactive Brokers platform to compare these, you'll see that Plug's revenue growth is actually outpacing most of its peers, even if its net loss is larger. This is the classic growth at all costs model that dominated the tech world for a decade, now being applied to heavy industrial energy. The problem is that in a higher interest rate environment, the market has very little patience for companies that aren't cash flow positive. That's why the company's Project Quantum Leap is so important. They are trying to cut $200 million in annual costs. If they can prove that they are becoming leaner while their revenue from electrolyzers is growing at double or triple digits, the narrative could flip very fast. What does this company actually do at its core? For those who might be new to the ticker via SoFi Investing, or perhaps just started an Interactive Brokers account to get into energy plays, Plug Power is essentially the plumber of the hydrogen world. They don't just make fuel cells, they make the machines that make the hydrogen, the electrolyzers, the tanks that store it, and the infrastructure that pumps it into forklifts for companies like Amazon and Walmart. Their business model has shifted from just selling hardware to trying to own the entire supply chain. This is why they are burning so much cash. They are trying to build the gas stations and the refineries at the same time. In their older reports, you'll see a lot of reliance on material handling, those forklifts, but the future is clearly in large-scale industrial decarbonization, like the steel plants and oil refineries we're seeing them partner with now. When we look at the macroeconomic pressures, it's a double-edged sword. On one hand, government incentives like the hydrogen production tax credit are a massive tailwind. On the other, the delay in the final rules for those credits has created a reality that is much slower than the expectation investors had 2 years ago. This is why you see so much volatility on the Robinhood stock charts. Every time a government official speaks, the stock moves 10%. But the savvy investors, the ones using Fidelity Wealth Management or specialized Interactive Brokers trading tools, are looking at the long-term contracts. They're looking at the fact that once a company like Galp integrates a 100-megawatt system into their refinery, they aren't going back to gray hydrogen easily. That creates a sticky, long-term revenue stream that the market isn't fully valuing yet because of the immediate liquidity concerns. Looking ahead to the next few weeks, the catalyst is obvious: the February 5th meeting. If the proposals pass, the company gets the flexibility to issue more shares. Now, to a smart friend over coffee, you'd say that sounds like dilution, and it is, but the reality is, without that flexibility, the company is back as against the wall. The market might actually rally on a yes vote because it removes the immediate threat of a reverse split and gives them the runway to finish their plants in Texas and New York. If the vote fails again, expect a lot of noise about a reverse split and potential delisting warnings, which would be the reality falling far short of expectations. The institutional activity in the last quarter shows that while some big funds have trimmed, others are starting to nibble again. If you're checking your Fidelity IRAs or SoFi ETFs that have exposure to clean energy, you'll see that Plug remains a top 5 holding in almost every hydrogen-specific fund. They are too big to ignore, but currently too risky for the set-it-and-forget-it crowd. This is a stock for the active investor, the person who is comfortable using the Robinhood app to swing trade or using the SoFi trading platform to build a position over time through dollar-cost averaging. So, where does that leave us? The expectation was a smooth governance transition and a pivot to profitability by late 2026. The reality is a complicated voting process, a restless shareholder base, and a stock price that is fighting for its life at the $2.30 level. If the company can bridge the gap on these votes and continue delivering projects like the one in Portugal, they might just survive the valley of death that claims so many early-stage energy companies. But if they can't get their own shareholders to show up and vote, it signals a deeper level of apathy that could be hard to overcome. To summarize what we've looked at today, Plug Power is currently caught in a holding pattern between its physical progress and its corporate requirements. The current price of $2.36 reflects a market that is skeptical of the company's ability to herd its shareholders into a yes vote by next week. We've seen that while the business itself is scaling, adding massive capacity and cutting costs, the financial overhang of potential dilution or a reverse split is keeping the big money on the sidelines for now. The contrast between the high expectations for a green hydrogen future and the gritty reality of managing a balance sheet has never been more apparent. Whether you're using Fidelity Investments for the long haul or the Robinhood cash